Welcome back to the Daily Crypto Roundup. If you've been here the past few days, you already know the story. The sell-offs, the panic, the late-night headlines. So today isn't about reliving the chaos. It's about understanding it. We're going deeper into the stories behind the numbers, from the tariff shock that triggered the pullback to the quiet accumulation that might already be starting. We'll look at what the data, the analysts, and the builders are actually doing while everyone else argues about whether the sky is falling. Before we dive in, make sure you're following the show on Spotify and drop a quick 5-star review. It helps more than you think and keeps these updates coming every single day. Now a quick look at where the market stands right now. Bitcoin sits around $112,449, holding steady after yesterday's wild swings. Ethereum follows at $3,847, still commanding the largest share of smart contract volume. BNB trades near $1,152, showing relative strength through the volatility. XRP changes hands at about $2.47, while Solana hovers around $184 after a heavy week of liquidations. Further down the board, Tron is at 31 cents, Dogecoin at 19 cents, and Cardano around 65 cents. Chainlink holds at $17.89, and Avalanche rounds things out near $22.75. Altogether, it's a market that's bruised but balanced. Volatile, yes, but still very much alive. Those are the live marks, each one a snapshot of a market that's been through the blender. Across the board, we're talking 5 to 6% shaved off total market cap in 24 hours. That's roughly $180 billion in value erased. And while most eyes are glued to Bitcoin's slide, the real story sits underneath, in policy risk, capital flow, and psychology. Let's start with the global picture because that's what's steering everything. Beijing has already signaled that it intends to respond to Washington's tariff escalation. This isn't background noise anymore. It's live ammunition in the macro arena. Every trader on the planet knows that when China and the United States spar over trade, the dollar tightens, yields creep higher, and liquidity retreats. Crypto isn't isolated from that. It's the first asset class to get hit because it lives on leverage and sentiment. When the tide of liquidity goes out, anything high beta catches the undertow. Markets are now pricing what analysts call policy reflexivity. Every new tariff headline begets a positioning shift, not because fundamentals changed overnight, but because portfolios must front-run what might happen next. So when Beijing warns of retaliation, algorithms instantly move risk down. Traders sell futures, hedge options, cut alt exposure. It's automatic, and it explains why the bleed looked mechanical rather than emotional. Then came the insider trading chatter, lighting up social feeds. Whenever we get a vertical move tied to a political headline, people go hunting for wallets that acted early. A few addresses rotated into stablecoins and short exposure minutes before the tariff announcement hit the wires. It's tempting to call that inside information, but in reality much of it is infrastructure. Algorithms wired into policy feeds scraping every government site for keywords. When a script sees tariff, restriction, or emergency order, it fires an automated hedge. That's not corruption, that's code. Still, the optics are ugly, and the public doesn't care about nuance when portfolios are bleeding. Expect watchdogs to make noise even if the story fizzles out quietly once the data proves it was simply fast hands, not privileged ones. The broader point is that retail investors are playing on a field where milliseconds matter. You can't outspeed the machines, but you can outthink them. The antidote to algorithmic chaos is structure. Plan your exposure, define your maximum pain, and don't let a flashing red candle decide for you. Panic is expensive. Patience is free. While fear dominated the top of the board, one token refused to break: BNB. Through the carnage, it held above the $1,000 mark. There are structural reasons for that. BNB's liquidity pool is thicker on its native exchange, and its user base tends to be less leveraged. When traders elsewhere were forced to liquidate, BNB's market makers had enough depth to absorb flow. That gave the appearance of resilience, but underneath it's still the same physics. Every coin eventually follows Bitcoin's gravity. Still, relative strength matters because it tells you where capital hides when panic hits. If BNB can continue to trade sideways while others capitulate, it often marks the early phase of stabilization. And speaking of real-world progress amid chaos, Gemini's expansion into Australia deserves a spotlight. At first glance, it's a small corporate announcement, but it symbolizes the quiet build-out happening underneath this volatility. When a regulated U.S. exchange sets up shop in a new jurisdiction, it brings compliant fiat rails, custodial infrastructure, and institutional credibility. That's how adoption creeps forward. Not through hype cycles, but through groundwork. For Australian traders, this means local access to a trusted on-ramp and potential AUD pairings that don't require international transfers. For the industry, it means another country shifting from curiosity to participation. Back to macro. This weekend's rhetoric will shape next week's mood. If Beijing's statement on Sunday night leans diplomatic, markets will interpret that as containment, and will likely see a relief bounce when Asian sessions open. If the statement is aggressive, hinting at retaliatory tariffs or tech restrictions, the dollar will spike, US yields will climb, and risk assets will start Monday in the red. That's why crypto feels hostage to headlines right now. It's not about hash rate or upgrades or DeFi yields, it's about whether the world's two biggest economies want to talk or fight. Analysts are split. The cautious camp sees this as the first domino in a longer trade confrontation that could squeeze global growth for months. The optimistic camp argues that both sides are posturing, and that cooler heads will prevail once the market reaction gets too loud to ignore. History suggests the latter. Markets do the politicians' dirty work. When asset prices tank, the tone of diplomacy softens. Until then, traders must live in the gray zone between rhetoric and reaction. On the institutional side, ETF flows are the next litmus test. After yesterday's liquidation wave, preliminary data showed modest outflows, but nothing catastrophic. That's significant because it tells us the big funds aren't dumping positions. They're waiting. Historically, when ETFs stop bleeding within a week of a crash, the next fortnight tends to be accumulation. Keep an eye on mid-week flow reports. If they flip positive, it's a strong tell that the worst is over. Social analytics across Reddit, X, and Discord registered one of the sharpest single-day drops in optimism since the FTX collapse. Yet on-chain data from Glassnode shows something paradoxical. Wallets holding between 1 and 10 Bitcoin actually increased during the same window. Small holders were buying the dip while Twitter was melting down. It's classic crypto psychology. Fear at the top, conviction at the bottom. If that trend continues through Monday, it forms the base of the next rally, whether people believe it or not. Ethereum, despite falling under 4,000, remains robust. Layer 2 volumes have barely flinched, and staking deposits continue to rise. Users are still transacting even as price corrects. That sticky engagement is the backbone of long-term value. Short-term speculators may have vanished, but builders haven't. Solana's story mirrors that resilience. After hitting $184, it's off roughly 6%, yet daily active wallets remain above 1.3 million. Participation, not price, tells the real story. In past bear phases, user activity collapsed alongside valuation. This time it's holding. That's proof of genuine traction. Cardano, Tron, and Dogecoin round out the mid-caps. All are lower, but Dogecoin's transaction count spiked just before the sell-off, driven by renewed chatter about its payment integrations with Tesla and other point-of-sale systems. Even in fear, narrative coins find oxygen. Meme liquidity keeps retail engaged, the market's pressure valve. Chainlink and Avalanche, meanwhile, do what quality infrastructure plays always do during turbulence: retrace less. Smart contract demand doesn't vanish because of tariffs, and cross-chain protocols benefit once volatility cools. Investors seeking relative safety hide in these names. Their smaller drawdowns prove that rule again. Many listening right now are angry. At politicians for creating chaos, at markets for being ruthless, at themselves for not taking profits. That frustration is valid. You're watching months of discipline evaporate because two governments can't agree on import duties. It feels unfair because it is. But emotion doesn't rebuild portfolios. Strategy does. Perspective is your edge. You don't need to predict every twist. Just survive them long enough to benefit when they reverse. Veteran investors treat drawdowns like seasons. Winter feels endless until the first thaw, and then everyone wishes they'd planted more. We're in financial winter, cold, gray, and full of doubt. But underneath, fundamentals are still quietly growing. The next thaw won't announce itself with fireworks. It'll start with calm funding rates, improving ETF inflows, and stable correlations to equities. When that happens, confidence will rebuild, not with euphoria, but with relief. Michael Saylor reminded everyone this weekend that there are no tariffs on Bitcoin. The line hit hard because it's true. Bitcoin lives in cyberspace. You can't tax its movement across a border. That message isn't branding. It's reassurance for holders who need to remember why they're here. Macro shocks shake price, but the code and supply schedule remain untouched. Saylor calls Bitcoin digital energy, energy that can't be destroyed, only changed in form. Economist Lyn Alden puts it differently. Bitcoin didn't emerge out of nowhere. It emerged from the failures of everywhere else. Every policy misstep, every debt spiral, every over-leveraged system adds fuel to its long-term case. Drawdowns aren't fun, but they have meaning. Each panic drives another generation of users to learn self-custody. It's evolution by volatility. Heading into next week, all eyes are on Monday's stock market open. If equities catch a bid, crypto will echo the move within minutes. If risk assets stay under pressure, expect another round of algorithmic selling before Asia closes. Active traders should map their ranges now. Pre-crash highs, liquidation clusters, midpoint retracements. Those zones matter. Random social media price calls don't. Discipline beats dopamine every time. For investors, the path is simpler. Zoom out, dollar cost average, secure your holdings. If you plan to hold long-term, hardware wallets like Ledger remain the gold standard. The link's in the description. Protect what you already own before worrying about what to buy next. In crypto, the first rule of survival is custody. The past week has been ugly, yes, but it's also familiar. Every major bull cycle included a moment that felt like the end, and each one built the conviction for the next leg higher. Markets move from fear to disbelief to acceptance to euphoria. We're deep in fear. Disbelief is next. Acceptance follows when charts stabilize, and euphoria returns when nobody expects it. If you're still here, you're already ahead. Staying when others run is how wealth quietly transfers every cycle. Now let's widen the lens a little further. Every crash leaves fingerprints in the data that shape the next phase of conviction. Funding rates across the major exchanges just flipped negative for the first time in 7 weeks. Traders are now paying to stay short. Analysts at QCP Capital note that periods of persistent negative funding have historically marked the early stages of reaccumulation, not capitulation. When everyone's betting against the market, the downside fuel eventually runs out. Marcus Soterio from Global Block adds that retail panic always peaks about 3 days before smart money rotates back in. After the emotional flush, open interest rebuilds quietly, ETF inflows stabilize, and sentiment normalizes. That's when the stealth recovery begins. OTC desks like Genesis and Cumberland report net buying bias, large clients accumulating rather than distributing. It may not move charts overnight, but it's like a deep ocean current turning. Invisible at first, unstoppable later. Michael Novogratz told Bloomberg that the tariff shock reset the risk curve, but hasn't dented adoption. Every sell-off in Bitcoin now finds a higher base of believers. Even JP Morgan's research desk, usually conservative, wrote that Bitcoin's correlation to gold could strengthen if tariffs persist and dollar liquidity stays tight. Institutional code for hedge demand returning. When bonds wobble and equities stagnate, Bitcoin reclaims its role as the speculative safety valve. Charles Edwards from Capriole Investments puts it beautifully. Markets are like lungs. They have to exhale before they can inhale again. The Fear and Greed Index plunged from 71 to 36 in a day. An exhale if ever there was one. Ethereum's Dencun upgrade is still on schedule. Gas costs low. Developers shipping hundreds of contracts daily. Builders haven't stopped. They never do. Solana keeps improving too. Over 2,000 independent validators now secure the network. A milestone of decentralization that Galaxy Digital highlighted as proof of efficiency and resilience. Across chains, the story is construction amid chaos. Macro parallels keep emerging. Since the tariff headlines, the Nasdaq is down about 2.3%, while Bitcoin's off 6%. Almost the same elasticity we saw during the 2023 banking scare, when Bitcoin bottomed 5 days before tech stocks. If history rhymes, stabilization could arrive midweek. Alden again captured the essence. Policy shocks create short-term fear but long-term validation for decentralized systems. Governments fight for control. Crypto thrives on neutrality. Paul Tudor Jones echoed that tone on CNBC. I'm still constructive on Bitcoin. The fiscal trajectory of the US leaves few alternatives for wealth preservation. That's central bank language translated into survival instinct. Meanwhile, stablecoin supply on Ethereum and Solana rebounded within hours of the crash, suggesting traders aren't leaving, they're waiting. Glassnode calls it sideline liquidity preparing for redeployment. The energy is shifting even if prices haven't caught up. First derivatives calm, then funding normalizes, then price discovery returns. Momentum doesn't flip like a switch. It tilts until suddenly everyone realizes the wind's changed. Asia will soon wake, liquidity will flow, and we'll see whether calm or chaos wins the weekend. If you've stayed this long, remember why. You're not chasing candles. You're studying conviction in real time. The loudest panic often marks the quietest opportunity. Bitcoin has faced worse. Ethereum has rebuilt from lower. Solana has resurrected from outages that would have killed lesser chains. Every survivor of panic emerges stronger. Stay tuned, stay steady, and as always, we'll see you at the top.